Hello, everybody. Welcome to my talk. I started reading chapter 4. It didn't do the complete chapter because it's pretty long, has a lot of information, but this chapter is about also investing in stock. So it's talking about stock, and I will just read, and then I have a couple of things to say myself. But for now, this is what I jotted down. A company issues stock for a host of reasons. The objective is to raise money. And some of the reasons are developing a new line of products, so where they're coming up with something new, expanding inventory. They people are buying it a lot, so they want to make more, but they don't have enough money, so they sell stock so they can get money, make more, sell more, make more money. Um, Modernizing existing ones. Building new plants here and abroad. That's one. And then modernizing existing ones. You always have to keep up, make it pretty and lasting. Financing a merge with a like-minded company. Bankrolling the acquisition of a pesky competitor. In turn, and those are some of the reasons why they sell stock. And in return for buying a company's common stock, the purchaser gains fundamental ownership. Fundamental ownership, equity in the enterprise, and is entitled to most, if not all, privileges that go with ownership of the company. I didn't write it down, but what I understood is you get to vote. Like sometimes I don't know. Like I have a bank account with a credit union, and I guess once you're banking, you're part of it. You don't have stock, but you're part of the company. Somehow it just works different than banks. But they send me things where I'm voting for something, or and it's the same thing that happens with stocks. Like if they have to vote, they'll let you know we're voting for this or we're changing this. And and they say, well, now you can vote there with the CEO, tell them what you think, but your vote is dependent on how much stock. So the more stock you have, the more you have invested in the company, the more say you have. The less, you're just helping out. But it's cool, all these little things, and to feel that you're part of the company, even if you just get one little stock. But anyway, just as with corporate and government bonds, income which is paid as interest, like with bonds, you get paid interest every 6 months, so twice a year. We learned that, right? And with stocks, it's called dividends. So interest, dividends, earnings on stock are taxable. So the interest and the dividends, the interest from bonds and the dividends from stock, it's all taxable. Like you make money, but the government takes their share. Not just federally, but across the board. So it's taxed like anything else you do is taxed. This is the reason some companies prefer not to pay dividends, but to automatically reinvest in the company. That I think we talked about it with last time. It's compound interest. So you get your dividends, and then they just add it to what you already bought. So now it's a little bit bigger, and as it goes, the longer you stay, the bigger your part and the company or the stocks. This can increase long-term capital gains of stockholders investment in company, and size of participation. What I was telling you, that the bigger your stock, the more say you have. Both big pluses, so they're both big, good for you, good for the buyer. Large companies offer DRIPs, which means reimbursement plans. Dividend reimbursement plans. They're called DRIPs, and that is like off the bat they tell you, okay, so I'm not gonna give you you have an option to just, I don't even send you the money or tell you about the money. It's just gonna go into what you already invested. So it's just gonna getting bigger, compound interest, which is really good for you or us, the investor, because it's growing. Hand in hand with privilege of being rewarded handsomely, if a company is wealth, if the company's wealth blossoms, gets bigger, you also have the risk of the company wilting. If a company goes bust and has to liquidate assets, holders of common stock get paid last. So if you have stock, that's the risk, and the company dies, they're gonna have to sell everything they have so they could pay what they owe, and the last in line are the stockholders. And it says after preferred shareholders, probably the people that own the most, the owners, the CEO, the people high up in the company, and then the bondholders. So bondholders get paid first, and then the stockholders. And that's all I have. But I wanted to say that I haven't bought any bonds, but I did invest in stock on Monday. The company that I'm coaching for, because I exercise, and I enjoy it and I love it. So I became a coach just the beginning of the year. And they went public on Monday, so I knew about it because, being a coach, I get all this information. And so I prepared myself, and I bought 12 stock. It was sold very inexpensive. It was $11, but I only had enough to buy 2. And then I added more money, like an hour later, and bought 10 more. And those I bought at 12, so within like an hour it went up $1. So I haven't checked. It was all whack on Monday, but I did that, and it's not that expensive, but hopefully it'll grow big and I will make money off of that. And it's a little bit, but it just, for starters, it was exciting to actually do that. And what I wanted to say is, in order to buy the stock, and it's like bonds. Like with bonds, you go directly to the treasury and buy your bonds there for free. But with stock, you go to the I forget what they're called, but it's the brokers. You go to brokers. And I have an account already set up, because with the company I work for, my 401k is with Fidelity. So I just called and, had them open me an account where I could trade stock and bonds and everything. So I that was at the beginning of the year, because I was gung-ho for trying to get out of debt and the ways I could do it, and one of them was investing, so I did that. And then I told my son, look, you should do this. And it was easier for him to open an account like from scratch with Ameritrade. So he opened an account with Ameritrade. He hasn't done anything, but but it's not that hard, because if he opened it and he's only 22 years old, just the information that he has, he was able to open it. Just go online and ask for it. I don't have, there's many, because when we went to look for his, there was many options to choose from, but I think one of the easier was Ameritrade, and that's why we went for with that. But you could go in there and look and just open an account. It's like opening a bank account. They ask for the same things. They ask a little bit more about your work and stuff like that, because they want to know, how much money you are going to be able to invest, or if it's worth it opening an account for you. I'm not sure why, but they ask for a little bit more things than they do at the bank. But it's really cool. You should try it. I'll let you go how it goes as I'm going. But there was a little bit more that I read that I didn't write down. But buying and selling stock is what I just told you about. It's through a broker, and I told you the couple that I know, Fidelity and Ameritrade. There's a lot more to choose from. Do your homework. And then it talks about stock valuation, and they go to say when you're buying stock is like going to the Macy's and seeing, what this costs here, and then you go to JCPenney and find the same thing for a lesser cost. So you want to like shop around the stock when you're ready to do it, because it's not, you don't just go and get it. And then they went to they talk about price to earnings ratio, P/E, PE, price to earnings ratio. That's important. And what they're saying, they gave a little formula here where it's what is it? It's the P ratio is calculated by dividing the market price of the stock by the current per share earnings of the company. And then they give you like some samples. But what I did read in this little price to earnings is that it's better that you buy when it's low. So when there's a recession or anything, it's usually because all the company stocks are down. So that's when you want to buy. And it does take, it says that you have to be patient, because sometimes it takes years for it to get back to where it was or where it wants to be, so you to make some money. So you need to be patient. But they also show, and I'll show you this really quick, a little graph that shows that if you want to make like real big money, so the book tells you to go with bonds, because it's less risky and you will always be making money, right? You will always make money, and the government won't default, so you will, a little bit of money that you make, you're going to be making it all the time. But if you want to make real big money, then stock is the way to go. But it's risky, and it's going to be, stressful, because as well as it goes up, it also goes down really fast. But they showed this graph, and these are the bonds and T-bills right here. And this is how they grow slowly. And these are stocks. So they plummet, but they go up. And when they go up fast and the furious, and make a lot of money. But when it's up here, it could fall, and you would lose everything you've invested. So you need to be really smart and really on top of it, if that's the way you want to go. That's why I only invested, because it does say invest the money that you are able to lose, because you might lose it. So don't invest your life savings here, because it could go bye-bye, and that is not something you want. But I bought it was like $130 that I spent on my bonds, and if you're interested, it's selling as Body, BODY, and hopefully it'll do good and prosper, and it's probably I will make millions with 120 invested, but it's fun to know that it's there, and it's like exciting. But that's all I have for you, and next week I'm gonna finish reading this chapter 4, and it's pretty long, so I think it's just gonna be all the rest of stock talk. And that was part 1 of the book, because then chapter 5 starts part 2 of the book, which is risk and rewards don't always go together. That's what the part 2 is called. So it's going to go into a whole new section, but we'll finish talking about stock next week. And thank you for listening to me. This was actually really fun and exciting because I actually did it. Haven't done bonds because I have to save a lot in order to invest in bonds, but stock is good because you could go there. I mean, this one was $11-12, but when you go in there, you see some that are like $5, and if you just want to play around and you have $50 to play with and lose, it's like going to Vegas. I always, when I go to Vegas, I do $25 because I'm not a risk taker. I do my $25. Sometimes it lasts me hours, sometimes it goes by in 5 minutes. But that is my limit for the day. Then I'll have another $25 for the next day. But not a big risk taker, so I'm excited about the stock, but I am hoping to save up $1,000 so I could do my first bond investment too. And I will know that I will not be losing that $1,000. If it doesn't make anything, at least it's gonna be just saved there for me. And bye again. I talked 2 more minutes with this excitement, but it's really cool. I really like, not that I'm doing anything, but just learning all the stuff, and it's just fun and exciting. I hope you guys feel the same way, and if you do and you want to listen to me next week again, and every Thursday I will be reading these books and learning more, because I have to become knowledgeable and sophisticated. Subscribe. See me. Adios, amigos.